So to start off the newsletter this week, I started talking about PCE, which is the Personal Consumption Expenditures Index. That was actually released last Friday, but we didn't have time to get it into the newsletter for last week. So PCE for the month of or I should probably first start by explaining that PCE is an inflation measurement, and it's essentially what the Fed looks at. The Fed looks at CPI too, but they prefer to look at PCE for a variety of reasons. But PCE was down for the month of December, or at least, from November. So from a year over year perspective, it was still growing positively at 5%. But that's down from 5.5% November, 6.1% in October. It's been on a steady decline for a number of months now. And on a month over month basis, it grew by 0.1%. So it's kind of nearing that CPI, negative month over month growth. So the main difference between PCE and CPI is just the way that it's measuring goods. So CPI looks at a basket of goods that generally stays the same over time. They do adjust the weightings of individual goods on occasion, but generally speaking, that basket stays the same. And it's looking at the sell price of those goods. So the price that the producers are charging for the goods. So PCE is similar, that it's looking at a basket, but instead it's looking at how much consumers actually spent on goods. So for example, like PCE is taking into account behavioral factors such as in a really inflationary environment where people are stretched financially. Maybe you're going to switch to generic brand cereal instead of buying the name brand that's grown really expensive, things like that. So that's kind of why the Fed likes to look at PCE, because it's a little bit more accurate of what the average consumer is actually spending. So core PCE, which is PCE excluding food and energy, came in at 4.4% for December. It was also down from November's 4.7% year over year. But core PCE did see an uptick in that month over month growth, which came in at 0.3% for December, which is up from November's 0.2%. What I thought was interesting is that core PCE is now down to its lowest year over year rate of increase since October 2021. And prior to that, it hadn't surpassed 4% since January of 1991, which I think is really interesting. And it kind of just, next we're kind of going to pivot into talking about, the Fed decision a little bit. And I think that, the fact that PCE is coming down alongside CPI is, weighed heavily into the Fed's decision to move down to 25 basis points. So, like I mentioned, and like I'm sure all of you guys know, the Fed, decided to raise 25 basis points on Wednesday, which was that overwhelming consensus that market participants were expecting, right? If you look at like CME Group's Fed Watch tool, which is based on Fed futures data, it says the market was pricing in a essentially 100% probability of the Fed going 25 basis points, which I thought was really interesting. And it certainly created, a level of risk, right? If the market's been pricing in 25 bips for the last several weeks and, they ultimately decide to go 50, then that would be potential disastrous scenario. But obviously that's not what occurred. And, me personally, just, this is not something I included in the newsletter, but I was kind of thinking, it's kind of one of those, buy the rumor, sell the news, is at least kind of what I was assuming, because, we've been pricing in a near 100% probability of 25 basis points for essentially the entire month of January. And I was kind of thinking, well, if the Fed does decide to go 25 bips, who's going to be left to buy, based on that news. But, clearly that wasn't the case. We've had a very strong last few days. So now the target range for the market interest rate, the Fed funds rate, sits at 4.5 to 4.75%, which is now up to levels not seen since 2007. So based off what the Fed decided this week and some of the posturing and rhetoric that Powell gave in his post-meeting press conference, the market's now pricing in a roughly 86% chance of another 25 basis point hike in March. The next meeting's March 22nd. And it's pricing in of roughly then 14% of the Fed actually not hiking and leaving rates at 4.5 to 4.75%. And it's giving essentially 0% chance of the Fed going back to 50. Also, it's currently pricing in a roughly 58% chance that If the Fed does go 25 bips in March, then that would, the futures market is giving a roughly 58% probability that that would be the last hike of this cycle, which I thought is, pretty interesting, and kind of leaves a lot of, risk on the table when the market is pricing in things with a, fairly overwhelming majority. It leaves a lot of risk for any sort of deviation from the plan to, cause a lot of selling in the market. This week, also the European Central Bank and the Bank of England also elected to increase their market interest rates. They both went 50 basis points, but both noted that they're looking at decreasing the size of future hikes. So from there, pivoting to the stock market, kind of what we've seen is, the Nasdaq is fairly overheated. It's quite overbought, and we're really extended from some of the shorter term moving averages that we like to look at as an area for buyers to be incentivized to jump back in. That being said, like I've said in the past few newsletters, if you're a consistent reader, just because something is overbought doesn't mean that it can't become even more overbought, right? And that it's the same way for like oversold. And I think a lot of maybe newer investors kind of get tripped up by that concept of, if you look at an RSI or you're just looking at price action compared to moving averages, or all these different avenues that you can explore to decide if you think an index is overbought or oversold. Just because something gives an overbought reading doesn't mean that price can't keep chugging higher and just become more and more overbought. And I think that's important to note. But I do think that we're kind of nearing an area where the indexes, specifically the Nasdaq, are likely to begin some sort of consolidation, similar to or potentially similar to what we're seeing from Bitcoin currently. So that about sums up all I wrote for the general market update section. Joe, Mitch, if you guys have any questions or any topics you want to circle back on, I'd love to talk about them.
Yeah, I'm curious. Like, this is a sort of a thought I've had about the idea of a soft landing, and I want to get your take. To me, it seems like inflation is, just as destructive to the average American and consumer as unemployment might be. And I wonder what's your thought on that, right? Because like people say we're in a soft landing because the labor market's still holding up strong, but anecdotally speaking, everyone I know seems to be in a really tough spot economically, just because inflation is so high. So basically, I guess my point is like it's not really a soft landing. Like the whole time has been just filled with turbulence, and I wonder if you got any thoughts on that idea, Blake?
Yeah, that kind of gives me two thoughts. Hopefully, I don't forget them when I'm explaining the first one. The first one is that like for the Fed to achieve their goal of lowering aggregate demand and thus lowering prices, they kind of want to see an uptick in unemployment. And obviously that's not what we're seeing, right? Everyone likely saw the jobs number this morning, kind of blowing expectations out of the water, showing that the labor market is extremely healthy at the moment. But like you mentioned, Mitch, unemployment and high inflation can have a similar effect on consumers because you're, in a sense, decreasing earnings, right? If you're not working, you're obviously earning less or earning zero, and if you have high inflation, that's outpacing the growth in your wages, and you have negative real wages, then that also is decreasing your earnings. So it has a similar effect. So the Fed, while the Fed is potentially looking for this uptick in unemployment, the fact that real wages are where they're at or negative, that kind of has a similar effect. Um, in speaking about the soft landing stuff, which I think is interesting. Obviously, you don't really know at this point, right, for with complete certainty whether or not you're going to get a soft landing or not. But I do think it's worth noting that in historic recessions, right, it's not like you necessarily are going to wake up one morning and you've had all these rumors about are we going into recession, or people discussing recession. It's not like you're going to wake up one morning and boom, you're in a recession all of a sudden, unless there's some black swan event. But so like metrics generally tend to ease into recessionary levels over time. So at the very beginning of a recession, or I should say moving closer towards a recession, it's going to look like we're starting to get recessionary readings. Oh, but they're not that bad. We're going to get a soft landing, and steadily over time they generally just get worse and worse and worse until the idea of a soft landing is completely out the window. Now, I'm not saying that that's going to happen, but I do think it's worth noting that as metrics and in all these different things we look at, employment, housing, earnings, all these different things, steadily get worse as you move into a recession. Historically, it can look like you're in a soft landing before things get worse.
Yeah, Blake, I think that
Yeah.
was really well said. And I think it's interesting to think about, right? Because looking forward, I could see like a scenario, maybe this is just my bullish hopium mindset, but I could kind of see a scenario where we look back on this in a few years. We saw, hey, this was the worst NASDAQ drawdown since, 2008, some of the highest CPI inflation since the 1970s. And like workers may not be unemployed, but like you said, they received material real wage decreases. And we could look back and be like, hey, maybe this wasn't even like, yeah, sure, we were like calling this kind of a soft landing at the time, but I mean, it wasn't like great. Like 2022 was a rough year for many industries, especially the tech industry. So, maybe that's like a bullish hopium look at everything, but it is kind of interesting, right? I mean, I don't know if we'll look back on this and be like, hey, that was 2022 was actually a pretty tough year. Of course, I say that could be exactly like you said, it could get a lot worse, but I don't know.
Yeah, 100%. I think that it's kind of just you're in this state where no one really knows what's going to happen, and you can analyze all the different markets and all the different metrics, and that can give you your best guess of what you think is going to happen. But at the end of the day, no one really knows, right? No one has the magic crystal ball. So from there, if you guys want, I can hop into the report that we just released this morning. So like I mentioned this morning, we just released the newest research report from Blockware Intelligence that covers crypto exposed equities and specific public Bitcoin miners. So the title of the report is Ranking Public Bitcoin Miners, a framework to quantify the liquidity, solvency, and profitability of public Bitcoin miners. So essentially what this report does is following 2022, obviously there was a huge spotlight shined on the health of these publicly traded miners, right? We saw bankruptcies, we saw restructurings, we saw debt to equity swaps. We pretty much saw everything you can do to avoid insolvency, really tailored in this one specific industry group, which I find fairly interesting. So what we decided to do is we examined 4 different categories for all of the public miners, right? There's 19 of them. So the 4 categories are the break-even cost to produce Bitcoin, um, the current ratio, the debt to equity ratio, and the cash ratio. And if you don't know what those are, don't worry, we'll get into them. But essentially, what we did is we aggregated their ranking, if you will, across each of those 4 categories, and use that to find a miner score. So the miner score is going to rank each of these companies from 0 to 100 in terms of their solvency, profitability, and liquidity. So the first category was break-even Bitcoin prices. So, and we calculated this using 2 different methods in the report. If you look at my tweet, which is posted in the Nest, I only touched on the first method that we use, but there is a second one as well. So essentially, for this category break even, what we do is we first look at the cost of mining revenue, which is reported on the income statement of in a 10Q or 10K. Which is those direct costs of mining, which is largely electricity cost. And then we divided that by the quantity of Bitcoin that was mined over that same period to give us roughly the production cost of 1 Bitcoin, so that you can estimate then from there. And obviously this is not exactly perfect, but if you understand their break even Bitcoin price in correlation to where Bitcoin's at now, you can have a general idea of what their profitability is like. And I thought it was pretty interesting. And looking at break even prices, you saw a lot of companies that had really high overhead costs or really high costs of mining, that made it so that they're not going to be profitable at any point essentially throughout 2022. So that was category number 1. Category number 2 was the current ratio, which divides total current assets by total current liabilities, which gives us a estimate or a measurement of the ability of a company to pay short-term financial obligations. So current assets are things like cash, accounts receivable, inventory, things like that. Current liabilities are your accounts payable, your notes payable, short-term debt, essentially. And once again, what we saw is we saw companies that have a ton of debt and not enough or assets to cover that debt. Like specifically, Core Scientific, Greenwich Generation, Stronghold Digital, TerraWolf. These are all companies that filed for bankruptcy or began some sort of capital restructuring in late 2022 or early this year. And these are the companies that had the lowest current ratios. So just looking at this metric alone, it really pointed out some of those outliers that were high risk in terms of their financial stability. From there, we looked at the debt to equity ratio, which I would imagine most of you guys would know about, and that's the total liabilities divided by total shareholders' equity. And that just gives us a ratio to measure how much a company is relying on debt versus equity financing and retained earnings. So these companies that have really high debt to equity ratios are companies who are having over reliance on debt. And that combined with some of the other stuff we've talked about can generate insolvency, or at least point you in the direction of firms who are potentially insolvent. And once again, we had some of those weaker names who underwent bankruptcy or underwent restructuring or deals to avoid bankruptcy, and those came at the bottom of the list with the highest debt to equity ratios. In the last category number 4 that we looked at to find the minor score is the cash ratio, which is looking at cash and cash equivalents divided by current liabilities. And that gives us a ratio that measures the ability of the firm to repay their short-term debt solely using cash on hand. So that means that when you have an interest payment due, do you have the ability to just pay that in cash, or do you have to sell your inventory, or do you have to liquidate your receivables in order to pay that? So once again, it pointed out some of the stronger names, and it pointed out a lot of the weaker names as well. So what we did from there is we took all of the the ratios of the break-even cost in each of those 4 categories, and we ranked the firms 1 through 19 based on if they had for example, a high current ratio or a low debt to equity, etc. And then from there we took their percentile rankings in each of those categories, summed them up, and averaged it to find the total mining score, which, like I mentioned, ranks these companies from 0 to 100 based off of those 4 categories we've just presented. And if once again, if you look at the Nest, you can see the charts and you can see all the data I provided on the Twitter thread. And there's a link to the full report there, which lets you read a lot more about this. And I'm not covering every single detail of the report. I kind of want to incentivize you guys to go check it out. I think it's pretty cool. So if you look at the thread, that top tweet, that top chart shows the public miner score, or the miner score of each of these public Bitcoin miners, and it also overlays the Q4 stock price data. And I thought it's pretty interesting because you see that for example, Core Scientific has the lowest miner score, and Core Scientific filed for Chapter 11 in Q4, so their stock price is down 100%. So and which I haven't noted is most of this data is based off of their Q3 earnings reports. Their Q4 stuff generally isn't out yet. So based off their Q3 miner score, this chart is looking at what then happened in the following quarter, and it's pretty interesting to see that some of the miners with the lowest scores, or the lowest financial health from this perspective, had the largest declines in their stock price in Q4. So that kind of sums up the report on a high level. If Joe, Mitch, you guys have any questions or want to talk about anything in specific, I'd love to get into it.
Yeah, Blake, this report was fantastic, right? I think there's been a lack of analysis in like the public mining sector because, a lot of equity research, traditional finance types, may have very little understanding of Bitcoin, but can, read a basic income statement and balance sheet. And then, other people are deeply into Bitcoin, but don't understand like the, detailed, you know, I guess relationship with financial statements. And so I think this report did like a fantastic job of understanding, hey, what are Bitcoin miners actually doing? What are the different business models that Bitcoin miners have? And then picking out, the top 4 financial metrics that make it easy to analyze which Bitcoin miners are best positioned for, any sort of solvency crisis. So I think this was fantastic, and I'm excited to see like where you take this as we go on to, future quarters.
Yeah, totally, Joe. I mean, and that's kind of the overlying theme with this report is I wanted to combine traditional finance with the world of crypto. So me personally, I'm a little bit more versed in the traditional finance stuff, traditionally speaking. but I work at a Bitcoin mining company, and I'm very passionate about Bitcoin and mining. So I wanted to create a metric that combines those two lenses. So, like you mentioned, traditional analysts at whatever Goldman Sachs that are covering this industry group, they may be more versed in the debt to equity stuff, the current ratio stuff, analyzing income statements, things like that, versus analysts at Bitcoin centric firms may be a little bit more focused on break even ratio or market cap by terahash, or things like that. So I kind of wanted to bridge that gap and create a metric that's looking at a variety of different perspectives to really gauge how healthy these firms are. And the findings that we made in the highest ranked or the lowest ranked miner scores appear to be very accurate to what's going on. But
Yeah,
like I mentioned, this data is from Q3, so it's a little it's certainly backwards looking. But as these firms roll out their Q4 earnings in the next month or two, we'll definitely be updating this report.
100%. And yeah, I think the minor score metric specifically, does a great job of boiling down all of the financial metrics and incorporating like the, qualitative like background of like what is Bitcoin mining, and it incorporates it into one simple metric that, anyone can understand, whether you have a background in Bitcoin mining or traditional finance or neither. You can understand, hey, Riot's ranked number 1, Clean Sparks, no, number 3 or whatever it is. And so I think it's super great metric and excited about it.
Yeah, definitely. And I obviously should mention that just because a firm has a high mining score, doesn't mean that you should necessarily go out and buy them today, right? This is just an evaluation of financials and profitability from a income statement, balance sheet perspective. So financial data that's reported in the income statement or the balance sheet is an estimate, and b, it's backwards looking, and stock prices are based on forward looking expectations of the economic environment in the future. So there's differences there. So that doesn't mean that you should just go short every miner with a low miner score and buy every miner with a high mining score. It's just an evaluation of financial perspective, and is not indicative of future price action. But from there, if you guys want to get into your newsletter sections, that'd be cool with me.
Yeah, we can. I'll make one comment. I mean, this is a fantastic report, Blake. But the one thing, it is sort of you can't really. There's qualitative stuff, right? Like this is very quantitative, but there's certain qualitative aspects that should also be considered if someone was gonna, buy a public Bitcoin miner stock. Like how is the management team, right? Do they have their heads on their shoulders? Where are they building their facilities? Are they in Russia or communist China? Stuff like that. So, but this was fantastic, Blake, and definitely, everyone should take a really deep dive into this. And even if you're not super interested in public Bitcoin miners, I think it's fascinating if you're into Bitcoin, period. But with that, we can go through the on-chain stuff I wrote in this week's newsletter. The first major metric I was looking at was the short-term holder and long-term holder realized price. The past few weeks, we noted how Bitcoin finally flipped short-term holder realized price, and then recently it's flipped the long-term holder realized price. So in aggregate, most people in the market are finally back in a state of profitability. Every time we've seen this dynamic has been at the bottom of the bear market. So, that's not to say this is guaranteed what's the bottom, but I think the longer we stay above long-term holder realized price, there's definitely more confirmation there. Like it's a higher probability that was the bottom. When we look at realized volatility, that's the second metric I looked at. I was surprised I thought for sure with the Fed meeting, we'd have a pretty volatile day in Bitcoin, but it really wasn't that much relative to past Fed days. And we are sort of seeing realized volatility slow back down, as we go through this consolidation period. So just be on guard. We like to look at realized volatility because obviously Bitcoin's very volatile. So once it goes through these consolidation periods, they don't really last long. And so when realized volatility gets to the bottom of its little pulse, as I call it, then you can expect a big day to come soon. Realized profits to value ratio. So this measures realized profits relative to realized cap. And this again, like the long-term holder realized price, we've reached sort of a level that's equivalent to past bear market bottoms. So just really trying to find stuff, to add to that thesis that, hey, the bottom is in. And I think realized profits to value ratio supports that. Another one is the realized profit to loss ratio. So the market is now has realized profits for the first time since April of 2022. And after, what is that, 8 or 9 months of net realized losses, now we've got realized profit. Again, seeing this behavior of profit taking after extreme profit or extreme loss, realized losses, is similar to the previous bear market bottom. So really all of the on-chain data is definitely pointing to the fact that the bottom is in. A black swan and macro at this point, I think it's the only really likely scenario that could result in a significant price drop. The number of addresses withdrawing from exchanges has been sort of flat throughout this list. Many, I don't know what you call it. It's not a bull run, but through the price going up this year, which basically that signals that a lot of the price appreciation is coming from a lack of sell side pressure, not necessarily a bunch of new buyers stepping in. There's certainly a lot of money on the sidelines right now, just sort of waiting for further confirmation that we're not going to go lower. That's sort of the short term holders and the traders, right? Because the long term holders, we haven't stopped buying, and so this increase in price has just come from fewer sellers in the market, not necessarily more buyers. And on that, we also looked at new entities. We want to see, hey, when are new entities coming in? When are new market participants stepping in to really bring us further out of the pits of the bear? And the momentum has flipped positive. So what that means is the 30-day moving average of new entities is greater than the 365-day moving average. So we've received more entities in the past month than we typically did throughout the past year, but not by a whole lot. The momentum just flipped positive. So that's something we're definitely going to keep an eye on throughout the coming weeks. And we definitely want to see, more people stepping back into the market. And then on the derivative side of things, the perpetual futures open interest relative to market cap continues declining. We've been looking at this for weeks now. It peaked right before FTX. And so this decline in open interest relative to market cap again sort of shows that the short-term holders and the traders are in risk-off mode still. They haven't jumped back in to be buying with extreme leverage throughout this recent price appreciation. And one last metric I looked at was the percent of futures open interest that is crypto margined. So that's like respective to the whatever crypto you're trading, right? So if you have a Bitcoin futures and you use Bitcoin as collateral or ETH with ETH as collateral, that's what this is measuring. And it being down means that most futures collateral is like a stable coin or US dollar and not actually the native token, which is good. That's showing risk off behavior, right? Because if you're using Bitcoin as collateral for a Bitcoin futures contract, obviously if the price goes down, your collateral is going to decrease in value too. So it's going to make liquidation risk a lot higher. So seeing this risk off behavior even after the price has gone down is definitely a really good thing, because we want spot to be the primary driver, and we don't want derivative degens jumping in and causing high price appreciation that's not necessarily stable, and that sort of behavior would likely not allow the price to stay elevated. And that's all I looked at for on-chain stuff this week. The newsletter's pinned up in the nest if anybody wants to go look at these charts.
Yeah, nice, Mitch. I think that was fantastic analysis. I really liked what you were talking about earlier about volatility, about how volatility to the upside, brings in so many new market participants, but then volatility to the downside wipes away all of the misallocated capital, all of the weak hands that have, weak balance sheets or don't have strong income statements, whether that's an individual or business. And yeah, I think that's a critical point. And I think when we go into these like deep dark bear markets within Bitcoin and we see these 70 to 80% declines and so many weak hands are kind of purged from the market, you kind of get this scenario of exactly like you were talking about, where there's just simply no sellers or very, very few sellers at least. And, the same DCA, type passive investing into Bitcoin, saving Bitcoin over time crowd, they remain. And when that happens, the price just slowly starts to inch up as the demand remains the same, but there simply are no sellers left. And Bitcoin is, the only asset in the world where there's no market-based supply response to an increase in demand, right? We have, proof of work combined with the difficulty adjustment. And so the only natural market-based supply response is increasing, the real value of those remaining coins, which basically means price needs to go up. And so I think that was well said in the newsletter. We were talking about, hey, Bitcoin's volatility purges the weak hands, price starts inching up, and we know Bitcoin, there's no natural supply response. And so the supply response, in a way, is just simply the price adjusting up when demand comes in. So yeah, I think that was very well said.
For sure, Joe. I appreciate that. And it's sort of cliche. A lot of people show the gold and Germany Weimar Marx chart, but it really is quite accurate, right? If the monetary system truly is going through a revolutionary change, which I believe it is, I'm sure a lot of people in the space believe it is, that's not going to happen without volatility, both financially and just geopolitically and culturally. So volatility is definitely a feature and not a bug.
Totally. I can transition into mining unless you guys have anything else you wanted to add.
No, go for it.
Sweet. Yeah, for mining this week, I mentioned 3 separate topics. The first one is kind of the whole chatter about ordinals or inscriptions on Bitcoin. Uh, and so, this week, as you guys may have seen, part of the Bitcoin community has kind of been chatting about all of these ordinals, NFTs, stuff on Bitcoin. But what does that mean? Like, I kind of want to dive into a little bit of background on this before explaining, detailed like the pros and cons, I guess, that people in the community have been talking about. So basically, after Taproot, which was a Bitcoin soft fork that was enabled in 2021, Bitcoin scalability and privacy were improved after this. But in addition, users can now easily store or more easily store any data they want on the Bitcoin blockchain, as long as they can convince a miner to include that data in a block. And usually, obviously, you do that by paying the miner a fee to do so. That's where transaction fees come in. So this idea of ordinals on Bitcoin has kind of caused a small amount of controversy, as now some blocks in Bitcoin look very unique. They have like one massive transaction that isn't necessarily moving Bitcoin from one address to another address, but it's just storing a massive monkey JPEG or whatever you want on the Bitcoin blockchain. And so a little bit of background of like, why this is important, or why this is something that people are, talking about. Bitcoin has something called the block size and block weight limit. And this means that Bitcoin blocks can't be larger than a certain size, right? There's a limit on the block size or the block weight. And so the current maximum limit is 4 million weight units, which is about 4 MB. And the reason this limit exists is to drive down the cost of running a Bitcoin full node. And so Bitcoin is unique among all crypto assets and traditional assets in that its monetary policy is the least uncertain. So there will only be 21 million Bitcoin because it is easy and inexpensive to run a Bitcoin full node, and each Bitcoin full node sets its own rules within the network consensus. So if everyone can easily run a full node, it prevents segments of the Bitcoin community or even large portions of the Bitcoin community from altering critical components of Bitcoin, like the 21 million supply. And so all other cryptos, either have a group that can push consensus altering changes, or it is simply too expensive or difficult for most people to run a full node, making their asset more uncertain as future changes could occur. And so taking it back to ordinals, JPEGs, and inscriptions, some people argue that using the Bitcoin blockchain to store large JPEGs, waste block space for no real purpose. But then others argue that, if someone is willing to pay the transaction fee to a miner, they should be able to put whatever they want in blocks. And, arguably for miners, this could actually be beneficial as blocks are now full. There's, fee pressure from this new potential source of revenue, but it is questionable, in my opinion, at least, whether inscriptions will be used, extensively, decades into the future, or if this is a short fad. I'm not too sure, but it is something that has been very interesting over the last few weeks. But that's kind of the breakdown of why people have been talking about this and why a block size limit is important, and why, some people are like, hey, let's not waste block space. Let's let, people actually use and transact Bitcoin, and pay, the lowest fee to do so. So it's an interesting debate, and it's, interesting to think about for sure. The second key topic that is in the newsletter, and there's a good chart in the newsletter, is just analyzing the future Bitcoin supply. So, as you guys know, there's only going to be 21 million Bitcoin. You run your own node, or you can run your own node to set that rule. And the idea is, okay, if there's only going to be 21 million Bitcoin, why mine Bitcoin? Like, why are people setting up massive infrastructure? Why are people purchasing ASICs? Why are people actually like setting up Bitcoin mining facilities, for many years? And it's interesting because future supply of Bitcoin is always going down, right? Since there's only going to be 21 million Bitcoin after each day, there's, for example, I think right now there's 900 Bitcoin mined per day. That's 900 less Bitcoin that will be mined forever in the future. And yet, even though the nominal future supply of Bitcoin is decreasing, there's less than 2 million Bitcoin to be mined, the real value of that future supply has been, exponentially increasing. So there's a chart in the newsletter that's very cool, and it kind of shows that, hey, the future value of the remaining Bitcoin supply is basically on a parabolic exponential trend, exactly like the price of Bitcoin. And so at Blockware, we kind of expect Bitcoin is still very early in its adoption cycle. And while there's less and less Bitcoin to be mined in the future, the value of that Bitcoin, in the future is likely going to continue increasing. And it's very interesting to see the chart and to show that, like, hey, just because, there were 10 million plus Bitcoin left to be mined in 2012 doesn't mean that the future value of that Bitcoin then was, the same amount of value that Bitcoin is trading at today, right? We have significantly less Bitcoin, yet the total remaining future supply of Bitcoin at today's market price is, about $50 billion, a little shy of that. So that's a lot of future Bitcoin to be mined. And if prices go up, like many expect, it could go, well into hundreds of billions, potentially even trillions. So that's the second topic. The third topic that I like to talk about every week is the Bitcoin energy gravity metric. And what this shows is basically the break-even electricity rate for a modern Bitcoin ASIC. And it adjusts what a modern Bitcoin ASIC is over time, depending on, what machines are popular. And it shows that, hey, when Bitcoin is going through a massive parabolic bull run, and it's about to, maybe the price is about to top, Bitcoin ASICs are literally just printing money. They're effectively willing to outbid almost all other uses of electricity, because they're willing to pay more than consumers are. And so typically when this happens, when Bitcoin mining is just unfathomably profitable, you just see that, hey, like, this is probably unsustainable. The cost of production probably has to rise. The price probably has to fall, and that's kind of what we see happen. We see Bitcoin go through these dark bear markets where miners become less profitable, difficulty continues to rise, mining difficulty continues to rise, and then eventually we see the price of Bitcoin kind of come back in line with its cost of production. And historically, when this happens, the most inefficient miners get purged from the network. We see difficulty fall, and these are what we call miner capitulations. And when miner capitulations occur, that typically, at least historically, is marked Bitcoin price bottoms. We saw two miner capitulations near the end of 2022, and it kind of gives us hope that, bearing no macro meltdown in 2023, that, it's decently possible that Bitcoin has already made a bottom. Those are the three topics for mining. I guess let me know if you guys have any thoughts or questions.
Yeah, my only really thought on the whole ordinal situation is it just seems like bear market shenanigans, right? When we're in the middle of a bull market and blocks are full and transaction fees are through the roof, I don't think anybody's really going to be paying all that money just to put a stupid picture on the blockchain. And then I know there's concerns about people putting bad images on the blockchain, but I mean that's Matthew Cratter did a really good video about this, and basically, if the government wanted to arrest you for being a Bitcoiner, they'd be able to find a reason to do so, not just because the node has inappropriate images. They would be able to find a reason regardless. So this isn't necessarily a reason to not run a full node just because you're concerned that someone may put illegal images on the blockchain.
Yeah, totally. And I definitely agree where what you're talking about, how like whenever we do actually have like a massive bull market, obviously Bitcoin scaling solutions are good and they're getting better, but by no means if we saw, 100x increase in users or people trying to buy, hold and save Bitcoins, transaction fees are going to rise, especially if people understand the importance of self custody, which it seems like throughout 2022, more and more people did understand or did realize the importance of self custody. And so, yeah, I totally agree. I think when transaction fees actually do start to rise during the next bull run, just because scaling solutions aren't completely built out, we'll probably see a lot of the monkey JPEGs and the ordinals not being used for block space, as people will be actually using the Bitcoin blockchain to settle high value Bitcoin transactions rather than, exactly like you said, posting, random images that don't really mean anything.
On your energy gravity thing, I think this can really tie in together with Blake's report. Basically, what you see at energy gravity is like right now is definitely the best time if you're going to buy a mining rig, because the price is relatively close to the cost of production. So once that rips off, there's going to be this huge arbitrage opportunity. It's going to cause the value of rigs to go through the roof, and if you're already online, you're going to be able to eat that arbitrage. So Blake's report sort of shows you what elements you need to be considering to when you're financing your own operation, right? You don't want to have too much cash, but you don't want to have too much cash and not be able to grow. You definitely need some sort of debt or equity, but you don't want to have too much and get wiped out during a bear market. So I think looking at energy gravity, it's like, hey, this is the best time to start mining. And then when you look at Blake's report, all right, what elements would make a good mining operation? Obviously, it's not going to scale. Like you're probably not going to run a publicly traded miner just off the rip, but you can scale that down to your own, garage size operation.
Yeah, totally. I mean, when I think about mining Bitcoin, it's an interesting proposition, right? Because right now you can look at something like energy gravity, see that miners are definitely better off than they were, a few months ago, back in maybe November, but they're still by no means raking in money compared to what happened in 2021. And so you kind of have the opportunity to buy mining rigs at very depressed prices, and because of the way Bitcoin works and the way that ASICs are commoditizing, if the price of Bitcoin rips, to 100K, we're not going to be able to see mining difficulty do a 5x in the same amount of time. In fact, it would take a very long time. And the reason it'll take a very long time is because ASICs are commoditizing. So the only way to get hash rate up 5x would be to build out massive, massive physical mining infrastructure all over the world. And so basically, like by mining Bitcoin, you're somewhat locking in Bitcoin denominated cash flows, because difficulty can't rise nearly as fast as price, at least in the short term during a bull market. And because of that, you're able to lock in these Bitcoin denominated cash flows. And if the price of Bitcoin is going up, that means the Bitcoin that you're mining becomes a lot more valuable, and then your electricity rate can stay the same. So yeah, I totally agree. I think Blake's report and the energy gravity report fit well together and kind of show like, okay, like when is it a good time to potentially be entering Bitcoin and the Bitcoin mining industry, and when is it a good time to be in a more risk off mode and be minimizing or eliminating any exposure to debt.
Yeah, 100%. There's obviously no way I could have said it better. I think that was great, and I think I totally agree that the two metrics are the two reports just play play together really well and provide a really all encompassing view of what's going on with Bitcoin mining right now.
For sure. And then that's not even to mention the report Joe sent out last week about the resale value of
Do
the
y'all have
rigs and
any
how that's
other subjects you guys really want to touch on?
Yeah, I think I heard Mitch.
Yeah, I don't know if my signal's being wonky or what.
You're good. What were you saying, Mitch?
Yeah, I mean, you sent out the report last week about the resale value of rigs and how that's super closely tied to the price of
I'm not
Bitcoin, of
hearing you,
course, and
Mitch.
then it's
I don't
also
know if that's just me.
I think it's just you, Blake.
oh, you can hear me then, Joe.
Yeah, I think you're good. It may just be Blake. I'm not sure.
Okay, yeah. I think I'm good. I just got a one of those little 100s from the audience. So, anyways, I lost my train of thought. But your report last week, I don't know if anybody, you may have missed that, and but basically it breaks down how the price of Bitcoin's tied, how the price of ASICs are tied to Bitcoin as well as time. And there's definitely physical depreciation. It is a computer. It does wear down over time. But if you are anticipating a bull run, loading up on ASICs could be valuable because there's certainly increasing liquidity in the ASICs market, and you'd also be able to passively mine Bitcoin. So it's definitely something to consider.
Yeah, definitely. I mean, I definitely encourage everyone in the audience to, check out Blake's report that he just put out today. Check out Energy Gravity, and yeah, check out our pricing ASICs report. I think it does a great way of analyzing how intelligent Bitcoin miners think about mining Bitcoin. Right, like these rigs do decay to zero over time in both dollar terms and in Bitcoin terms. But if Bitcoin, goes up, at least in the short term, these rigs will also go up in value. And so it's an interesting way to think about these ASICs because you can see the older generation ASICs may decay very fast, but they might have a high beta relative to Bitcoin if they go from deep out of the money to deep in the money. I think like Matt D'Souza, who's one of the late co-founders of Blockware, put out great reports back in 2020 about how S9s, which were old gen at that time, were basically the cheapest out of the money call options you could get on Bitcoin. And that's exactly what we saw happen once we saw the 2020, 2021 bull run. We saw S9s appreciate 3x more than Bitcoin during the bull run in a very short period of time. So yeah, I think the pricing ASICs report kind of does a great job like analyzing how to think about Bitcoin ASICs. Even though they are assets that decay to zero over time, there are definitely alpha opportunities within the Bitcoin mining industry. Cool. I think that might be good to wrap it up. Blake, Mitch, any other thoughts?
No, nothing other than be sure to go check out the newsletter and check out my report if that's something that interests you. That tweet and my thread about it is still posted to the Nest, and there's links to it in the newsletter as well.
Thank you everybody for listening. As always, take your Bitcoin off the exchange. That's going to be my closing statement.
Absolutely. Thanks everybody.
See you guys. Thanks for listening.